Hey guys and girls, welcome to this week's episode of the OBS and Birchy podcast. I'm your host, Nathan Birch, and it's the show unraveling the truth to the facade of the 21st century when they're exiting the matrix and waking up to motherfucking reality. Today, special guest, Ridhwan. Thank you for coming. How are you? It's been a while since we did a podcast.
Yeah.
Today we're going to talk about selling properties, and there's people out there over the last couple of years trying to sell properties. Lots of people are always trying to sell properties, but my investors that I bought them properties in the Gold Coast when everyone was bidding on the Gold Coast for 150 grand, 200 grand. They've gone up to 700 grand. They're selling them off, stuff them out, drilled. It's gone up from like 200 to 800, those sorts of things. And I see that people are selling, and I see that some people sell cheap. I see that some people sell well priced. And I know when I'm buying a property, I'm trying to screw the seller down and get the price as cheap as possible. That's what people pay me for. But I've seen a need. So there's two parts to this. One is I had to expand Blink Property to do sales. So we do sales out there. We haven't really advertised it, but we've been selling for years properties for investors. But within that, we're not financial advisors, little disclaimer. So we can't give you advice as to sell or not to sell and whatnot. But, things to consider from a tax perspective.
Yeah.
Things to think of from a selling perspective of, what will that mean and how can it affect you positively or negative. And that's why I thought it was important to get Ridhwan on. Talk about from a taxation perspective and whatnot. So, Rid, I guess for those that might be tuning in for the first time, 30 seconds, what you do, who you are.
I'm Ridhwan Hannan. I run OnePath Accountants. We've been working with Nathan for 10, 12 years now almost. Yeah, it's been
years.
By the way, happy birthday. It's your birthday week coming up.
I was probably past by the time it was on, but thanks, bro. It's when we started working together, I had pimples and shit, and now they're like grey hair and
Grey's here.
Yeah, greys. We've been skinny guys, fat guys, skinny guys again. It's been a while, big journey we've had. So
it's been good. So yeah, look, we do a lot of property investors, a lot of Nathan's clients, a lot of clients around Australia who are dealing with properties, businesses, trusts, super funds, everything in between. We see a lot of property. We see a lot of people sell property, buy property, some mistakes, not necessarily mistakes as such, but best ways to continue getting ahead in your journey and making sure that you're doing the right thing right and you're not giving any more tax away than you should.
Yeah.
And making sure that whatever you're going to be doing has an outcome, effectively, is what we like to sort of say to our clients, that, we're your partners in this journey. As you grow, we grow.
Yeah.
So it's important that, clients always have these kind of considerations when selling, buying, and continuing their property journey.
Yeah, cool. I guess if someone was to sell, we just want to talk about selling, what sort of things should people be considering before they sell from a taxation perspective, and what sort of questions or communication should they be having for planning with their account?
Yeah, look, I think there's an earlier conversation is that a lot of clients are selling now because of rate changes.
Yeah.
And I think you and I have spoken on many podcasts that we know where rates were, what they were before when they were really low.
Yeah.
You were buying, and I remember still some client engagements and seminars we've had where people were saying to you, hey, Nathan, what's happening with Queensland? When's it moving? Should I sell now because it's not moving? It's been year 6, not year, you told me it was going to be 3 years. So I think clients have to get into a position that they understand why they're selling properties.
Yeah.
A lot of the questions that we answer, although they're tax driven, sometimes just bouncing ideas and saying, hey, what's the outcome? Why are you selling this property? What's next?
Yeah.
And some clients just want to get themselves out of a financial jam, a bit of pressure, all those different things. So I think
we've seen people that go through different phases, right? We've got people that are retiring, but we've got people that build a half portfolio, then got sidetracked and started,
for sure,
build a house with a granny flat and stuff like that. Then we've got other people that have, done something stupid in their business life or done something stupid
for sure,
that's hurt themselves. And the instant thing that they do is, oh, the properties, I'll just sell them.
Yeah.
And it's like, well, you don't think about what happens to recover that property later.
Correct.
Still service for that property. Could I go rebuy that asset? What tax implication? And then, there's people out there that sell and then they go, shit, I haven't thought about that. And they don't look at all angles. And they're like, well, I have to sell another one now to get the taxes. And
without a doubt, right? And I think that's really before you get to the point of selling properties is why you're selling. Are you trying to achieve more growth within the property portfolio? Yeah. And it's not a question for us, but as the accountant, sometimes we're the first people that clients ring up and say, hey, I'd like to sell this property. What does it mean? So obviously you've got big things like capital gains tax, depending on how long you've held it for.
Yep.
If it's a long-term investment more than 12 months, your tax is going to be around 23.5% on any gain that you've made. It doesn't actually matter what loan you have, despite how many times we tell clients that the loan is irrelevant. It's actually what you purchase the property for. You might have Division 293 tax because it might push your income over 250,000. So you end up having to pay a little bit more tax based on your income for that year. Because you've gone over 250,000, the government puts their hand in, takes a little bit more because you've got a little bit of super.
What that means?
So Division 293 tax is essentially a tax for the high income earners, regardless of where that income comes from. So if you're on a salary more than 250, you'd be very used to paying 293. So it's effectively another 15% on your superannuation contributions. They tax a certain part.
Anything over, like, so on from the first dollar in the super contribution?
On your super contributions, correct.
Even if it's the first 25?
Yeah, they just end up taxing you more. So it's about, end up taxing you on the top rate about $4,500, right?
Yeah.
So it's a little bit of a painful tax that you can get. And if you have a capital gains event and that pushes you up over the 250 mark.
For some strange reason, I'm always earning less than 100.
That's actually not true. So, all these little bits and pieces that you have to consider, which your accountant can certainly get you across, are things you need to consider, because you might sell and say, hey, I've got to pay back my loan. I've got to pay back the tax. I've got to pay Division 293. And at the end of the day, you're not really left with a huge amount of capital to be able to get you to that next phase, get you out of a jam, or whatever reason that you've actually come to the conclusion that you need to sell. You just have to think about what I call T+1. T being transaction day or the date of exchange. What happens the next day, right? And a lot of the time we speak to clients and we don't say to them, good, bad, buy or sell. It's not our position. But what will you be doing after? And some clients, and it's okay, say, look, I just want out because I don't want the pressure. I don't want this type of, constraint on my lifestyle, and that's totally fine, right? But some clients are like, well, I'll think about it when I get there, and I think that's a problem, right? So tax is definitely a consideration that you'd consider. So again, capital gains tax, Division 293, you might have things that you haven't paid along the way. Land tax, you might have to, if you haven't paid that because you've had cash flow constraints, you might have to settle that bill as well. So there are a few things that occur. One big thing that clients don't often realize is that you might get put on a PAYG system. So after you pay a tax bill, which is big, they then say, hey, we think you're going to pay it again. And they then cut that bill up into 4. And so the first quarter out of paying the tax bill, you might get another bill and you're like, hey, what's this about? You need to come to us. We get that removed. But all these little key considerations as to what happens.
I've noticed something, like a couple of people that have sold have come back and they're like, what's this thing that they need to do? It's like to get a release now.
So
a clearance.
Foreign land tax clearance.
No, I think it's like ATO, like when you sell it, you have to get a clearance. Otherwise they keep 15% of your...
Yeah, so basically trying to tell the government that you have no foreign interest in your property. So it's a foreign withholding land tax clearance. And so... Now, it used to be before a certain threshold you had to get it. Now it's pretty much every sale that you have to do it. It's very easy form. You just fill it out. If you're an Australian citizen or you're a trust, for example, you get your accountant to do it. Then that non-withholding certificate is effectively released. So, but if you don't have it, they withhold 15% and that gets thrown into the wash whenever you do your tax return. So we had a client who couldn't get it in time and, obvious sale, he needed the cash and the lawyer withheld 15% and sent it off to the government. And he has to wait till he does his tax return before he can have claim to that back. He didn't actually have a tax bill or any capital gains out of it, but he just didn't get it in time. So you just got to make sure that, again, your outcomes are going to be met with why you're trying to sell that property. Because, to your point, really key is that getting properties is really difficult. Selling properties is actually quite easy, right?
Selling these, someone's going to buy it.
Someone's going to buy it, right? So I think it's important that clients get that full advice from both their advisors, their brokers, and their accountants to what are the actual implications of selling.
So I guess, like, determining of when to sell and all that, like to try and minimize tax. Like, if you're selling, I don't know, let's say 3 properties, I guess, this financial year, next financial year.
Very common question.
Like your wife's name and your name, who's going to be loaded up with
right. So
bag.
Property selection for disposal can be important. Timing can also be important. Now, I often tell clients that if you sell 1 or 3 or 10 in a particular year, it may not have a big impact because you might already be on close to the top tax rate, once you consider the actual selling process,
Yeah.
and the event that comes out of that. Obviously, properties in Australia are quite expensive, so you might have hundreds of $1,000s coming into your income for that particular year, and so you might already be on the top rate. And for properties which are long term, in terms of investment, it's 23.5%, right? So timing can be important, but timing where you're selling an individual property can be really important. So we're at the moment in 1st of May, right?
Yeah.
So if you signed a contract to sale today, it's on signing.
Yeah.
It's not on when you settle it, right? So it's on exchange, not actually when you settle it. So if you were to sign and
all those poor bastards that do delayed settlement for.
Yeah, it doesn't actually, right? So it's when you actually sign that contract, when the other person signs the contract necessarily.
Feel sorry for it.
That date, right, is you're buying usually, so it's okay.
Yeah.
So that's the date that you pay the tax, right?
That actually takes us to another thought, right? If someone, there could be strategic, let's say someone hasn't got a job this year and whatever, right? It could be better to put it like it's important. Is it
like as in if you can kick it over to 2nd of July, that means you pay the tax in that financial year. And if you use an agent, you get an extra 9 months to pay the tax. So it could be an extra 18, 20 months that you actually get to pay any tax bill. You can invest that. You can offset with other existing loans that you have. You might want to park it. You might want to use it.
Yeah.
You obviously need to pay the tax when it's due, but you get a little bit more flexibility with that cash.
Yeah. I think being able to, it's an interesting one actually. Come into my spiel of when I'm doing structured financing I've structured deals like delayed settlements and stuff. It could work in pros and cons. So cool. And reasons for selling, I guess some people want to just get out. Some people want to get money. Someone might be doing it tough. Someone might be thinking, okay, I'm going to go into another type of venture.
Yeah. Look, I think from our point of view, the worst reason for selling is not having a reason. Yeah. Right. That's the actual, like,
I'll just make 200 grand. It's gone up in value.
Yeah. Right. Like, and so it just has this very reaction based, emotion based. It's gone up, or the key one I hear, this property's not going to go up anymore. Have you heard that one? Yeah.
Oh, yeah. It's ridiculous. We've got a common client that like I've bought for, and they're like, oh, the Sydney ones, they're no good. The Gold Coast ones, they're no good. Let's sell them, right?
Yeah.
Right. And the Gold Coast ones go up. Oh, let's sell the Sydney ones. They're not going to go up. But it's like Gold Coast went up, not in line with Sydney. Sydney's gone up, not in line with that. When I'm buying assets, I don't want to buy in the Gold Coast today at fucking 700 grand. That's stupid. I want to buy it when it was 200 grand. So I've got other locations. I don't want to buy in towns for like 400,000 for a 2-bedroom villa. I wanted to buy there when I was paying 90 grand, 130 grand, 140 grand. So some people just think, oh, well, it hasn't gone up for 5 years. Well, it's not going to go up. It's like, well, you're buying right at the bottom.
Yeah. And I think where clients sell to buy, even though we don't make commentary on it, that's at least a thought out decision, right? Yeah. So tax is one element of it. Yeah. But it's only a certain percentage. On a long-term basis, 23.5%. On a short-term basis, could be 47%. But the rest
of the top rate.
That's at the top rate, right? So you might have a property which is in your partner's name, and they're not working. So we've got a progressive tax rate in Australia. So you might end up paying slightly less than 23.5%, depending on how much you've made from it. Yeah. It's always good to get a capital gains tax calculation, which we do for clients, because clients go, hey, how much capital gains tax am I going to pay? You'd be surprised how many clients go, I thought I had to give away half, right? Even though it held for 15 years, right? Or is it in super? It's only at 10%. Or is it in a trust and you can park it in a bucket company at 30%, right? So all those different considerations mean that having a conversation about what you're about to do as opposed to what I've done is really important, right? And so I think for me, I love when clients come to me and say, hey, I'm thinking of selling. Yeah. And then we have an open and broad conversation about, okay, great. Yeah. Why are you selling? And you'd be surprised how many clients go, you know what? Maybe I'll just hold the fire for a little bit, right? Yeah. And even something simple like we're on the cusp of a rate cutting cycle. Yeah. Should I sell now or should I sell later? It's a conversation to be had. Yeah. Regional versus metro. Yeah, absolutely. Yeah.
Some people think that, you buy it in Sydney, it's going to go up, or you buy it in Perth, it's fantastic, it's gone up. And like, why do you want to buy at the top of the market? Have you not looked at the fact that Sydney may not have gone up for 10 years? I'm buying stuff in Sydney in 2025 cheaper than what it was in 2015. I'm buying stuff in every state that's like that. So, what is the drivers for that market? What could be the future potential drivers? What are they doing with migration? What are they doing with construction?
So all those considerations, tandem selling. Sometimes we have clients who are making money on one property and they say, hey, should I sell a loss-making property? And we say, okay, well, these are the considerations. We've had, unfortunately, some clients who have sold a profit-making property in 1 year, kicked it over to the next financial year and sold a loss-making property. And we go, hey, you didn't have a chat with us.
Yeah.
Do it the other way around. You actually get to claim the loss, right?
Okay.
And so those are the things that you'd like to have a chat with, your advisors in that regard.
Yeah. And I guess so 23% was a good figure to set aside for taxing night for surprise. What other things can we do to make taxes disappear? Or
look, there's a lot of TikTok advice which says that you can do A, B, C, D. Some of it's true, some of it's not true. The probably the better ones which are true is that you can mitigate some of your tax. You might not be able to offset your entire tax bill, right? Now, a really common one that we get a lot of commentary and feedback on is contributions to superannuation. We've talked at length about self-managed super funds and super funds generally, but you do have a position with the tax office, depending on how much your super contributions have been over the last 5 years, to make catch-up contributions. So if you've missed your cap by, say, 10 grand a year for the last 5 years, you might have an additional $50,000 you can push into super.
You've put nothing in there for the last 5 years?
Or, your income...
5?
Yeah, absolutely right. So if you've never made a contribution because you're self-employed or anything like that, something you should be doing, so speak to your accountant and make sure you do. But if you didn't, you could certainly put, 125 or more because the cap's gone up to 30,000 for this year, for example. So you might be in a position where you can put money into super. Now, the kicker is that it may not offset your entire tax bill, but you may be worse off from a cash position. You're better off from a tax position, but you're worse off from a cash position because you've had to push money into super and you've still got to pay a tax bill. So you had 100,000, you put 40 into super. Great, your tax bill's chopped down from 50 to 25, but you still got to pay that 25 and you put 40 into super. You're out by 65, right?
And then you can't touch it till you're 60.
So it's future you, but often clients go, hey, I'm going to put this money into super. Great. I'm going to hold on to the balance. No, you probably still have a tax bill that you need to consider. And so we have to work out your net cash position, because if you're again going to buy another property and you go, hey, Nathan, I've got 100 grand, post-tax I'll have 75. But then you actually go, oops, I put money into super and I had to pay a tax bill. Now I've only got 40. You might never ever get what you want, right? So you have to stage that out. So I think that's part of the TikTok advice that people don't tell you. And it's really important. You can do other certain things, which is prepay upcoming expenses for certain rental property expenses, interest, those type of things. So if you have a lot of capital with you and you go, okay, well, I'm not buying anything, I don't need the capital, I like to just be tax efficient. If it's appropriate for you, you can prepay your interest for a year, for example, you get a big tax deduction, right? Now that's just a tax deferral scheme and that's purely tax motivated. Those are the things you can consider. Obviously, you could be in a position where you make wider contributions to, your family pool, depending on how you own that property. If it was in a trust, for example, you might have other members of the family who would take on super contributions.
What about if, this is not a real scenario. It is not a real scenario. But let's assume that I had a brother, right, just hypothetically, that owned a construction company. I'm just making it up. I don't have a brother that owns a construction company, but just assume that I did. And then there was some works needed to be done, and there was 50 grand worth of invoicing that I had to do, and I had to pay that upon settlement. Would that become a capital
for him?
Well, it would be a capital loss for me, and then it would be if the
works are genuine at some length.
Of course.
If you're disposing of that property, and you have some capital works that you haven't accounted for, then I wouldn't use your brother. I wouldn't use an arm's length.
I just made that an example. I don't have a brother that's a builder or anything like that, so I just made it up, right?
But one big consideration, because you brought that up, is that when you do end up working out what your capital gains tax is, depreciation is a double-edged sword. So when you're claiming depreciation along the way, you're getting a notional deduction for
the capital base,
decline in equipment or the roof or the floors or whatever it might be. Whatever you've claimed along the way, you add back to your disposal, to your cost base, right? And so you might end up having more capital gains tax.
If you claim 10 grand a year for the last 10 years, you paid 500 grand for the property, and then you sell it for $1 million. You've made 100 grand of deductions, so the cost base goes down to 400,000.
Yeah, exactly right.
So you're paying tax on 600,000.
Now it's always better, because if you're doing long-term disposal, you're paying the tax back at 23.5%, but you've claimed it at a higher rate, typically, depending on what your income level is. But typically, you've claimed it at a higher rate. So it nets out. It's okay. But it is definitely a double-edged sword. We've seen plenty of clients go, oh, my guacamole.
Yeah.
That's a lot more than I thought I had to pay.
Yeah.
And it could be clients that have you've not been with your accountant for many years, right?
Yeah.
And so you've only been with your accountant for 2 years, for example. You're with someone else for the last 8 years.
Yeah.
We then request all the documents. We say, hey, you've actually paid $50,000. You've actually claimed $50,000 a year in depreciation. We've got to add all that back, right? So again,
it's having a full picture.
Full picture, get an estimate, make sure that you understand what your contributions would look like. If you did make it to super, what is your actual position?
What about if you own the property for 20 years and then, let's say I've come to you for the last 3 years as an accountant, just hypothetically, and then the last 17 years, the property's been deducted, but it's been via another accountant, and then the other accountant died or whatever, or no longer in business.
Yeah.
How far back do they go?
So it's meant to be for the life of the property.
But if the person doesn't know, because people are...
So all your tax returns are actually lodged with the tax office.
So it'll show it on there.
You can request it, yeah.
Okay.
So they do a lot of information matching, data matching now. So if they've got a property address, they'll match it up pretty quickly.
Yeah.
They'll send you a letter saying, hey, have you forgotten your depreciation, right? So
Yeah.
very common. I wouldn't recommend anyone necessarily pursuing that pathway.
Yeah.
But if you can't or you don't have your documentation, accountant's closed down, passed away, whatever it might be, do your very best to get it.
I always ask these dumb questions. But what about this? Yeah.
I would say that you probably want to be in a position where that long arm of the tax office is pretty long.
Yeah.
So they can always come back. We had a client yesterday who had a similar position. We just said, hey, just go get the information because we don't want the tax office to knock on the door 10 years later and say, hey, by the way, you forgot that. And the tax office is pretty good in that regard. They're pretty comfortable with saying that,
they're pretty good, are they?
They're pretty good in the sense that if you can't get all the information, they'll allow you to make some really, positive estimates.
Yeah.
And that's good. But if worst case scenario, you can actually get all the tax returns that you've ever lodged.
Okay. Beauty. And I guess like when you sell the asset, a lot of people don't look at, the fact of, and I'll just cover off this one for a second. Like if you're selling a property, are you able to go rebuy that asset again? What are you doing with the loan facility? Can you use that loan facility to roll it over with a new security? Portability loan? Would you service the new loans now that you've sold off the asset? And I think that's where a lot of people don't look at the question.
For sure.
And I guess like from the sales process, like what is the best outcome you can get, right? Like, and just as we were talking beforehand, I might go off topic here for just something like selling on terms, right?
Mm.
What is the reason why you need to sell? Is there a way that you could minimize your tax by staging that sale over a certain period of time, cash flowing in a different way? Could you wrap that deal back up in a different way and sell it off of a stage payment? Delayed settlement, vendor financing parts to it to maximize the sale price out of that and to get a higher return than what you would from just selling it straight on the market. Is the agent the best agent to get the best result? Are you just trusting? I see so many people that just trust an agent and go, oh yeah, how much is it worth? Oh, it's worth $250. Oh, okay, I'll sell it for $250. And it's like, hang on a second, there's other sales at a $320 and there's nothing else on the market, but the agent fucks the people up. So just on the flip side of what I do for when I'm buying, you should be looking at making sure you're not dealing with those agents on the sales side.
Yeah.
So make sure you get someone that's going to get the maximum price.
Huge problem that we see is that because we see a lot of clients, properties in similar areas.
Yeah.
And we have clients who sell at the same time. And the prices are actually quite different, right?
Yeah.
And it's sometimes purely down to the agent because the agent's getting incentivized to sell baseline.
Yeah.
Extra 20, 30, 40, 50,000 makes no difference to the commission.
Yeah.
So they just go, okay, cool, we'll sell it. So that's not to say the agents are bad. They might be dealing with
what they've got. Shit. I love them.
Yeah.
So sort of me. Right? So make sure that you're not doing that. When it comes time to selling, reach out to the team, reach out to myself, reach out to my team. We can put you in contact with someone that if you really do want to go down that road that can sell to get the maximum sort of
getting
start
advice when selling, I think, is equally as important as when buying.
Yeah. I guess like hidden cost of selling that people may not think about is things like, fixed rate home loans, rate cost fees, mortgage costs. People think that they bought a property for 200, they're selling it for 600, but they pulled equity out and now they've got a loan at 400,000. and they're like, oh, I've just got to pay tax on between 400 600.
Yeah, you'd be so surprised how many times.
I'm not surprised. I see it. I have these conversations. It's like, no, it's your cost base of what you paid for it. You pulled the equity out. The equity is tax-free loan. But when you sell it, you have to pay tax all the way back. So do run the numbers, because you could be surprised or hurt yourself from the wrong advice or no advice or guessing or hoping or
100%. And if you're in a position where you've got, which hasn't happened for many, many years in Australia, negative equity, it's an even bigger problem, right?
Yeah.
Because then you have to eat that debt at some point, right? Yeah. Either selling something else or putting it onto another property, and then you overburden that property.
Yeah.
So it hasn't happened for a long time, obviously, because we've had a very positive uplift on property markets, in the last 5 years.
Mm-hmm.
It's been a bit of a downturn recently, but that one there where you're not getting as much money out of it because you've got a debt position after tax, after everything else, you're left with nothing, and you go, hey, I just sold a property and I sold that income stream and I've got nothing to show for it, right? So it's really quite important.
And just remember, folks, when you sell a property, you no longer have any access to capital growth. You no longer have access to future cash flow from that property. You have lost it. You don't have that asset anymore.
And you don't have the credibility with the bank.
Yeah.
Because they may view that property very differently to what you view it, right? Yeah. You think it's a burden. You think it's in a position where it's draining money from you. But on the other side of that balance sheet is that it's going up in value, or it's in a positive area, or like what we're seeing in New South Wales and Victoria now.
Yeah.
Suddenly, with all the planning changes, all these properties are being rezoned. Like all these really underperforming properties, suddenly they're in, blocks of land which are valuable, right?
I look at the motels. I would never, it's not something I recommend people buy motels. I bought motels. I bought them cheap. I bought them well. And I look at it and I think to myself sometimes like, should I have done that right? Because when you buy them, you got staffing, you got headaches of all these different things. You got many moving parts. It's not just like buying a normal property. But I think about it, it's like, well, that portfolio made me sit at a table from a different seat with different positions, and give a different level of discussion that can be had more on a commercial level rather than that, from purchasing the property on a commercial level versus just a residential mum and dad.
But even something like value
the
of
land,
property.
The value of the property, the value doesn't determine based on the fixtures and fittings. They value it based on the income generated from the business that operates there. So they're very, very different. People always ask me, should I buy a motel or whatever? I'm like,
but even like something basic, the motels that you've bought,
a
lot of them are way below replacement value.
Exactly.
Like to build that again would cost you
the depreciation schedule. I've got depreciation schedules in the tens of millions of dollars for something, right? And I paid cents in the dollar for that.
Yeah, correct.
The tax lien on those things are fantastic. So they've had tremendous value that's been attached to them that have added in different areas of my business or my life that have been able to benefit me, which isn't seen on the top service.
Yeah. And, those considerations are for commercial type properties. You might have GST implications. You might have going concern implications. So really, really important when you're not buying stock standard residential properties in normal regional metro areas, that you double check all those things, because you might buy a property and then they go, hey, by the way, you need to pay GST on top, or you might have to pay GST on the way out, right, for example. So you just got to be careful, right?
And the gatekeeper is always there. They're always there. They're always coming to collect, right? So
So it's one of those things where just make sure that when you're trying to get ahead with any sort of financial decision, particularly based in property, is that all of what's going to come of a particular sale. And a purchase is slightly different, but a sale is, it's final, right? You can't undo it once it's done.
So I guess, just as a final note as well, like rational decisions, emotional decisions, sometimes someone might be stressed, they might be, under duress with financials or whatever. I guess the first thing is like, is selling the best option? That's the first thing. Is it the best option? Could you go refinance? Could you pull some equity? Is it a clutch? Some people sell because they need 20 grand or they need to pay for a wedding or something. Like, fuck me, dude. Like, silly, right? You can't go back and buy this thing again, right? Like, you could just pull the equity. You could go and do whatever. But the understanding of the debt isn't that sophisticated. So they go, well, pulling the equity out isn't as good as, I could just sell it. I don't have to take on more debt. And it's like, well, you sell it, you're going to trigger off 1, 2, 3 things that go wrong. Rationally thinking about it rather than emotionally.
Correct. Yeah. I think we've had a mutual client who actually had a fantastic portfolio. And he bought it in quite a short period of time.
Yeah, like 20 properties. There's a
wasn't that
couple
much.
of them. There's like
It wasn't that many. It was like 8 or 9 really solid properties, really good purchase price.
maybe
And
it's a
then
different person I'm thinking.
yeah, I think it is a slightly different person. And then I think the properties became a little bit not difficult to manage, but it's paperwork and all those other different things. And lovely guy, he sort of said, no, I just want to simplify my life and I want to buy my own PPOL.
Yeah.
And that's important to me, right?
Yeah.
And then I was doing the numbers when he sold, and in my head I was like, oh my God, we don't say don't sell.
Yeah.
But I was kind of saying, hey, have you had a chat with Nathan about this?
Yeah.
You bought this at 150, you're selling it 2 years later at 450.
Yeah.
You made really good money. And that was like several properties like that.
Yeah.
He's like, no. I just, to some extent, I felt like he didn't want to talk to you because he'd say no.
You knew that. Yeah. Ignorance is bliss.
Yeah, right. So, totally, right. And so, he's paid a lot of tax on the way out.
Yeah, wow.
Did it on a really short time frame. And it's got him to that PPOR. So it was successful in that regard. But I don't think he set out with that. Yeah. So always repositioning your goals, always repositioning what you want. Doesn't matter what the outcome is because it's, that person's life at the end of the day. But I think is being honest with what you set out to do.
Yeah.
And getting to that point where you go, okay, great. My position has changed. My outcomes have changed. I'm happy to own that.
Yeah.
But it shouldn't be in a state of like, I'm just doing it because it's emotional. And I really felt emotional.
Yeah.
And, he actually became emotional in the meeting. And it's like, I just need out. Like, it felt like a lot for him.
Yeah.
But it could have just been maybe selling one, like the headache one.
Yeah.
Right. But you throw the baby out with the bathwater, right?
We've seen others that have like changed the strategy and they had 20 and then they sell and buy blocks of land and build. Like I've seen a lot of that over the years. And then I'm like, you just missed all these greatest booms that you could have ever seen. And they're like, oh, it's only a 200 grand property. It's gone to 400. It's never going to go up. I'll go buy the $1 million property and then turns to 1.3 and they go, oh, I made 300 grand up. But that 200 grand property that turned to 400 is now at 800 or $1 million. And it's like, they didn't see the value that was underlaying that transaction. So,
and it's kind of like what we spoke on a different podcast about, which was trusting that process.
Yeah.
And also being in a position where if you don't know how you got there, keep trusting that process.
Yeah.
Because if you go, okay, hey, I've done this.
Yeah.
Or I've been at, I've run, the city to surf.
Yeah.
Now I can go do a full marathon.
Yeah.
There's a process to it, right? Like you can actually get there, or you go to the gym and now you think you can, go do BBT, right? Or be a VA, right?
Yeah.
I think that's the important part. So whilst we, from an accounting point of view, only deal with the tax element of it, because we see so many things, you kind of become like a confessional box. People go, yeah, look, I'm selling to do A, B, C, D. Yeah. And we give honest feedback, or we can't say don't sell or, you should sell, for example.
Any decision that people make is going to change their life.
Yeah.
Positive or negative.
Yeah.
Ain't going to change the bed I lane, ain't going to change bed duty lane. It's not going to change our lives. It's up to them. And we can only give feedback or spur on questions or create a conversation.
Correct. Yeah. And so I think that impact of selling has tax, has borrowing, has future implications, but it all should be overlaid with the fundamental goal.
Yeah.
And if you're diverting away from that, then look at those next elements. Like the tax is important when you're 100% set on selling, right?
Yeah.
But if you're selling for the wrong reasons, then the tax is kind of it's a downstream problem, right? So I always tell clients is that the same way you bought a property, sell a property with the same level of advice, right?
Yeah.
Go see a buyer's agent, go see your accountant, go see your broker.
Yeah.
Am I going to get to the next step? And I think that's the conversation piece that often accountants, and you get on TikTok advice, for example, is missed, right? Is that, this property circuit that you're on actually has a point, right? Because if you're just collecting them like Monopoly, then at the end of the game, you go, okay, well, I don't care, just give it all, back to the bank and you wrap it all up. But if you've got it, should it be in a trust? What are the tax implications of that? Is it in a super fund? What are the tax implications of that? Is it in your personal name? Again, what are the tax implications? So I think that the question in and of itself is selling properties is always going to be a part of a journey, always, right? You can never hold on to it ever. Death will get you.
Yeah. It all goes back in the box.
It all goes back in the box, right? But you just need to make sure that you're doing it for the right reason. So you don't have to go all the way back.
Yeah.
Or like we see the clients that get to 20, then they go back to 6.
Yeah.
And then they end up at 20 again. You've just
waste a
lot of time and money. Yeah.
Cool. Thanks for that, Red. I appreciate the insights. Are very, very important. I think a lot of people miss out on that. If there was one last piece of advice that you could give to people just randomly around this topic, was there something that comes to mind that you could say in one snapshot that,
Measure twice, sell once.
Okay.
Right. So if you're sure that you need to sell,
Yeah.
make sure double check all your bits and pieces.
You can't undo it.
We can't undo it.
Right. Park the car out the front of the house.
It's really tough.
Painting the house. It's no longer yours.
We've had tons of clients, and I use that word often too much, tons. But it's where they sell and they look back.
I shouldn't have done it.
They shouldn't have done it, right? Like we had clients who sell just post-COVID.
Yeah.
Everything in Queensland.
Yeah.
I panicked, heard John Laws and all those guys on the news and, the whole works, and sold everything. And at a critical juncture in their lives, where this was the retirement play, like they'd invested for the last 4 years for this.
Yeah.
And then hearing, water cooler news on the news, barbecue news, everyone's news.
Everyone's opinion.
But never coming to, their advisors, right? Yeah. Because sometimes, again, ignorance.
Well, we go to someone who's got hundreds of properties and other people that are dealing with people with dozens of properties every day of the week. What the fuck would they know, right?
Yeah, and sold them all in one go, paid big tax, 293, didn't make any contributions to super, couldn't offset anything. And I saw them at tax time and I was like...
It makes me sick. It makes me sick to see that.
Sometimes clients call me for really, really small things, which I'm cool about. Like they'll say, hey, I'm buying a laptop. Can I deduct it on tax? I'm like, yeah, cool, no problems, right? If you're an IT technician or you're a teacher or you're a professional, you can do it. But then these big things, they don't pick up the phone or they don't send an email. And, if you have sent an email and we haven't got back, get what you want, pick up the phone and speak to us. So I think that's probably the best thing. So measure twice, cut once is usually what they say.
Yeah.
In this particular scenario, sell once, right? Because you can't undo it.
Yeah.
Yeah.
Very good advice. Very good advice. Thank you, Rid.
No worries. Thank you for having me.
How would people connect with you?
Best way is to drop us an email, info@onepathAccountants.com.au. Send me an email, schedule a call. We'd love to have a chat, personal, trust, super fund, or just have a discussion. We often say to clients that, if you take away from what we say and implement it with you and your advisors, we're happy because, we just want people to grow.
Yeah.
Yeah.
Beauty. Thank you. I really appreciate that.
No worries.
If you guys need help on building the portfolio, want to speak about an agent to sell with or run through scenarios of different conversations that people have had with you, work out a strategy is the best thing to sell or not to sell or get some finance advice, whatever the case may be, you can hit us up 1300 367 925 admin@binvested.com.au. There is a link to have a chat with my team, which is binvested.com.au/discovery session. You can type that in your browser as well. And if you like this, please share it and give us a like and leave us a comment below. And we'll catch up soon. Have a great week. And remember, Google Play, Apple Play, Spotify, and YouTube. Bye for now. Thanks.
Like Bilal said, man, we stuck in the matrix. This my advice, don't care if you take it.